It's okay. So we were talking about bonds, right? So bonds are just again debt instruments which represent that the company has issued their bonds or notes, I would say, along with the company seal or stamp or signature of the authorized person. So that documents will call it as a bonds basically. So let's see how it looks like. So we have that. See this certificate. The certificate will treat as a bond. Company can include the face value of a bonds here. Market value of a bond can be different, and even the issue price of a bond also it can be different. So it depends on the demand, supply, and there could be other factors as well. Companies in a position, how company sound in terms of financials and all, which is depends on all that other factors. It's not something that company will decide and something it will happen quickly. No, nothing like it. It's just a process, so that every company they will have their different process in place and they follow it. All right. So same example now. If we see how basically bonds that investments works, we have in the first half we have discussed that equity, preference equity, and even bonds as well. So bonds is nothing but company issue that bonds. Who is texting? Let me. Bond is not visible. I have shared my screen. Okay, hold on. Can you see it now, guys? Okay. See, insurance also come into picture in bond investments, but in a different way. As an investor, always we try to protect bond investments through insurance strategies. Insurance it means which is CDS, credit default swaps. So basically, investor always they'll try to mitigate or control the risk through different derivative strategies. All right, so we'll discuss that. We'll have a session on derivatives part also in detail. So in that session, we can cover derivative, percentage. So now let's discuss about this bond investments. Let's say this ABC Corp is looking for investments, and Mr. A is interested to invest $1,000 investment, right? With 4% interest payment for per annum. So, as per the example, how much is the volume? Okay, let's take this one value. So, instead of 1000, I would like to take it as a 10,000 because it will help you to quickly calculate. So, total fund the company is looking for a $10,000, and Mr. A is agreed with terms. Terms it means if we talk about, let's say, terms. See, on bond investments, this person will receive coupon. Correct. Along with coupon is nothing but guide. Again, it's a promise of interest payment. If we talk about bonds, bonds offer interest payment. It's another brother of loan investments. If you offer any direct credit or loans to anyone, what happened? You receive interest payment on investments. Let's say you have taken loan from the bank, then in that case what happened? Again, if you have taken loans from the bank, then you will have to make interest payments to the bank, correct? So in the same way, if we talk about bonds, see, the bonds is again, as I said, another brother of your loan investments. So company come up with the bonds process and they issue bonds, certificates to the this means investors. But if I talk about this example, so bonds terms, all terms you would see here which is included, but this is not actual certificate, right? On actual certificate, all these terms you can see where company will promise interest payment or coupon payment of a bonds, maybe let's say uh, semi-annually, quarterly, yearly, or at the time of maturity. So that depends. Then you would see another thing is rate, coupon rate, which is 4%, 3%, 5%, right? So that coupon rate you can see where company actually include all of that information in the private placement prospectus as well as on certificate of a bond. Third, types of a bonds, which is a very important one, guys. Let's say redeemable bonds, convertible bonds, putable bonds, callable bonds, zero coupon bonds, junk bonds. Then any other different purpose or let's say strategy if that XYZ institution has, on the basis of that they can issue that different types of bonds also. Maybe let's say senior bonds, junior bonds, prime prime securities, right? Senior securities. You would see a number of series or names, but ultimate, or if you ask me like what is that exactly, see, it's a debt process only. You might say different names, but at the end, where the company has raised funds through bond investments, bonds, let's say instruments, and company is entitled to pay interest payments and principal back to the investor at the time of maturity. That's all. If you see the flow, bond investor invest money in company, and then again same company invest that money somewhere, maybe acquiring company assets, technology, or expanding business operations, or to repay the debt payment of other vendor. So that depends. And then same company which is entitled to return the coupon payment along with the capital if I talk about, so this amount will treat as a capital. And here if you see, we are paying extra $1200 dollar, so total amount company will pay $11,200. So it means company is entitled to pay interest payment along with capital. Now your another question would be like, sir, why investors should invest in bonds? See here, if you see, if you invest every year, you will receive around $400 return on investment. All right. See, as an investor, you have multiple options. You can invest in cryptos, equities, bonds, real estate, or even you can offer a direct credit to anyone. But if you don't want to invest in all of these options and you are looking for a, let's say, secured investments option or strategy along with passive income, it means passive payout income, means after every year you will receive fixed amount of return on your investments. So if you look at that perspective, then this bond investment is good. You can invest, you will receive XYZ amount, whatever, let's say, which is available. You can open your, again, same process we have discussed. You can open trading account, you can open which is demat account. So once you buy securities, then broker will help you to settle that securities in your demat account. Then you can make a payment of securities and you can hold securities in your demat account. So once you hold securities in demat account, company capture the data through brokers or custodians or any marketplace if they have, and accordingly company also will update your name in the books of company, and you will start getting interest payments payout in your account as per the bonds certificates or coupon rate. All right. So this is just a normal process of a bond, and throughout the maturity, you would see at the time of maturity, here basically at the time of maturity, you would see multiple options. Options in terms of, as I said, in a preference equity, what we have discussed, redemption of a bond, then conversion of a bonds into equity and preference shares. So here you can convert bonds into preference equity, as well as you can convert bonds into common stock. Nowadays, which I have seen, you can convert bonds into loans as well. Why loans? It's just a restructure in a process. If let's say your bonds investments has been matured, and if company is not able to repay that on time, and let's say you and company both have a mutual understanding, then what you can do, you can retire bonds from the company's balance sheets and convert bonds into loans through restructuring process with different interest rates. Then what would be your benefit as an investor? Of course, you can negotiate with the company to pay higher interest payment to you, and on loans definitely you would see higher interest rates, right, if you compare with the bonds. So as an investor, you will receive more interest payment basically. All right. Then why company will pay, convert bonds into loans and pay extra let's say interest payment? Again, as I said, if company is facing any liquidity issue, right, and if the company, let's say, they're facing some issues to arrange that amount of capital, then of course they'll also try to settle down that matter for a time being. So they'll get a time to arrange the money as well, and maybe then in future then they can repay the loans as well. Because restructuring, which is kind of something, bond investments, when you convert into loans, then the investor will ask you to convert bonds liability into EMIs, and then through EMIs you can easily repay it as and when required, or as and when you will have a liquidity available in bank account, you can pay it. So this is how basically your restructuring process happened. When we say restructure, it means company want to restructure the debt into different formats. Then why company will convert, let's say, bonds into equities? See, as I said, if you feel that you won't be able to repay the debt immediately, at least for next 5 years and 10 years, but the bonds investments, let's say, liability has been matured, and anyways you will have to retire that from the retire, it means mature immediately, then what would be the best option? There would be two options. One, ask bondholders to take a control and repay your remaining amount if they can, and recover their amount. That's the one. Second, if you don't want to give a control of your business to the bondholders, then negotiate with them and convert their debt into directly your equities. So in that way you can share your basically ownership with them. Then you will not have any pressure on your head to return the debts and all. But if you share your if you dilute your stake or allow other people to grab your space, then ultimately it will affect on your earnings and ownership rights as well. Let's say previously you were holding 100%, after restructuring might be you will have to dilute your stakes. Depends on the liability, maybe 10%, 20%, 50%, 15%, depends. All right. So basically this is how your bond investment works. But now let's talk about callable bonds, why and how callable and puttable bonds works. So in this session I would like to cover this too. So remaining, then I will means after this discussion I'll allow you to ask questions from your side, because rest bonds types, there will be different types, but maybe some portion we can cover it tomorrow as well. See, there are two the popular bonds types, and that helps companies as well as investors to take a decisions or to manage their investments, basically bond investments, in a very systematic way. And what are these ways? See, if I talk about, let's say, if company issue callable or puttable bonds, same bonds, you would see the feature which is call and put. So it's a basically derivative feature. If I say, let's say, that feature will allow investors or companies to sell out investments or to buy it back, same investments from the investor. But again, question would be like, sir, how that, let's say, bonds will works in the market then. So let's talk about one by one. If I talk about, let's say, callable bonds, who issue the okay, if I talk about callable bonds, who issue the callable bonds? Of course, company issue the callable bonds. All right. Call, which is something buy process. Call, it means buy it back. Buy it back. Write down somewhere. Call, it means buy it back. Sir, what is buy it back? Buy it back bonds from the investor. Let's say initially, as per the initial agreement, the bond was issued for 3 years with the provision of call. Call, it means up to 1 year, company will take a call and call the bonds at any point in time, but the condition would be after 1 year only, right, from the issuance of, let's say, securities. Let's say securities had issued in the month of January of 2021, right? After the December, let's say December or maybe January, 1st of January 2022, after that, company can call that bonds any point in time. Any means any. So if I take the current example, let's say this year is 2023, this year is 2024, right? Let's say in the month of January, bond was issued. January to January, you would see 1 year. So now we are entered in June. Let's say company here decided to call it, back the bonds from the investor. And when the company call it back that bonds from the investor, always company will pay some callable charges as well. Maybe 1%, 2%, 3% extra. Let's say if company is calling bonds at same price, which is $10,000, then company will pay extra 5%, 2%, 3%. So that call rate that already would be provided or highlighted in the investment prospectus. Now the most important question is, sir, why company will call it, bonds from the market? Can anyone guess why company will call these bonds back from the investor? Why? I'll give you 10 seconds to think. I want to check it out, your thought process. Why company will call the bonds early? Basically, if I talk about this example, company should call the bonds after third year, means whatever the maturity date is given, on that date company can call the bonds. But company decided to call the bonds early, or maybe let's say immediately in the month of January, company decided to call the bonds. There could be two possibilities. I'll just give you a hint. Let's say one case is where company has received huge cash from the operations and company now want to utilize that cash to repay the debt. That is a one possibility. Second is the interest rate of, bonds in the market, which has been dropped significantly. Maybe let's say 2%. So now just think about it. How and why company call the bonds back? I'll give you 30 seconds. I just want to check it. Any guesses? Send two messages. Rest. Okay, let's discuss. See what why company call bonds. First, as I said, if company has earned revenue and if they have received, let's say, huge cash flow from the operations. Anyways, it's a common tendency. If you have received, let's say, cash in your pocket, you will also try to repay the loans, whatever loans that you have taken. If I, you know. If I give you my examples or your examples, right, at a personal level, what we follow, if you have received, let's say, huge cash in your pocket, we always try to repay the debt on time. Why? Because so that you can avoid interest cost and remaining amount that you can invest and generate more returns. That's the one aspect. Second thing is, let's say, let's forget about callable and putable. Let's say you have taken loan of 1 lakh at interest rate of 15%, and up to one, and you are paying, let's say, 15,000 for per annum to the bank. Up to 1 year, let's say initially you have taken loan from the HDFC Bank at 15% interest payment for per annum. Up to 1 year, the another bank, let's say Axis Bank, who is offering loan, which is personal loan, at 10% interest rate. Let's say you got a call from a bank. Look, mister, we have seen your liability that you have 1 lakh rupees outstanding loan from the ICICI Bank at 15% interest rate, but we would like to transfer balance and give you a facility. So we'll convert your same 1 lakh into personal loan facility with the interest rate of 10%. So almost you would be in a profit of 5%. So you can save basically 5,000 interest cost for per annum. Don't you, means, give me a genuine answer. Don't you try to reduce your liability in this way? Will you try, right? Yes, no. Do you agree with this, guys? You will try to reduce that, correct? Okay. So same thing if I say in a market, this, let's say, this bond was issued at 4% in 2023, and in 2024, let's say the market interest rate, which is at 2%, right? Market interest, it means due to RBI policies. We have discussed that money markets and interest rates and all in detail in one of our session. Let's say RBI announced rate and the current market interest rate is 2%. What if you call a bonds back from the investor and reissue the bonds at 2%? Again, let me tell you something. This process won't be easy. The reason is, issuance of a bond is, again, means reissuance of a bond, which is a costly process. It means every time whenever you list your new bonds, you will have to appoint brokers, lead managers, underwriters, custodians, depositories, banks, and they'll charge huge cost to you. Correct. It's not something easy where you can easily convert your bonds, means 4% bonds into 3% or 2%, and you can issue. No, you cannot easily convert it. But if you see the huge gain, which is 2%, means you can save the interest cost, which is almost 50% interest cost. See, this amount is $10,000, but what if, let's say, this amount is 10,000 crores? So basically, this 2% would be around 200 crores, right? 200 crores interest payment that you are paying every quarter, let's say every year. Sorry, not 2%. 400%, 400 crores you are paying interest payment for per annum. And immediately, let's say, due to interest rate change in the market, if you can reduce your interest payment liability by 50%, then definitely you can call bonds from the market. So previously issued bonds, you can call it from the market and appoint bankers and ask them to reissue the bonds in the market again. Now, your another question would be like, sir, look, how bank will repay the debt then immediately, right? How bank will repay the debt of first investors, let's say Mr. A, let's say 10,000 crores. See, in that case, that's what your investment banks come into picture. They'll arrange short term funding to you. So they'll arrange facility to you, which is loan facility. All right. So you can immediately withdraw the capital from the facility and repay the debt of bondholders, and ask bank to issue the bonds in the market again to raise capital, right? And once the bank has received capital, then again company will discuss with them, look, now you can repay the debt of the facility which was withdrawn to repay the debt of bonds. And that's how company will settle down that. And here, if you see, in this particular transaction, company can save up to 2% interest cost for per annum. So it means, why, if you see now question around, like why company call the bonds, as I said, if there is an interest rate change in the market, then company can call it securities back at any point in time, but they'll first complete the certain maturity period, 1 year, 2 year, 3 year, which is a mandate one. Now, if I talk about puttable bonds, see, same example, but in case of puttable, investor will get the rights. So this person will get the rights to sell. In case of puttable, Mr. A will get the right to sell the bonds in the market. This person will sell the bonds in the market. That's all. So it means he'll hold the bonds with him. He or she will hold the bonds with him for 1 year. And then after here, that Mr. A will take the decision whether this Mr. A can sell the bonds to the company back or not. Again, it's an option. Now, your another question would be like, sir, why Mr. A will directly sell out bonds to the company? Due to interest rate. Let's say this company is paying 4% interest payment on your investment. And in market, let's say current market interest rate is 4.5%, or maybe let's say 6%, 7%, whatever it is. So don't you think that you are losing your opportunity gain if you sell it out this, let's say, security back to the company, and same amount if you can invest in other bonds or other companies' bonds, so you can earn 6%. So here you can see directly appreciation in your interest payment almost by 50%. So don't you sell out bonds back to the company and take the money back then? I'm sure everyone will try to do the same thing. Are you getting my point? So basically, puttable option which help investor to sell the securities back to the company up to certain period. Why? Because of, let's say, if there is any better opportunity if investor found in the market, not in terms of only bonds, guys, but even if I talk about, let's say, money market or stock market or anywhere, if that investor has any better opportunity in place which can offer more return than the current the return which the Mr. A is earning, then definitely Mr. A will sell it out securities back to the company and recover his investments and capital back. So this is how your puttable and callable bonds works. All right, so let's talk about few examples and calculation price of bonds. There are many other types as well, but here we'll focus on the puttable and callable types, these two, and let's see if we get the time, then we can cover that portion also. So these are the key points. Same points you can replicate to the puttable as well, but we have covered most of the stuff from a callable perspective. If I talk about callable bonds, so date of a call is important. These bonds come up with a specific call date, typically mentioned in the terms and condition, as I said. On this date, the issuer can exercise the right to redeem them, usually at a price what is decided on, and this is known as the call price or call premium, right? So basically, they'll provide price and everything in the draft only. And as I said, let's say the face value of the bond is $1,000 or INR, then you might see the premium which is different, which is 1108. So basically, it's a benefit of investor. So investor will receive 108, which is extra amount. Otherwise, why investor will buy it back? Again, it's an option, right? Then call protection period. These bonds usually have a call protection period. The issuer during this period will not be able to exercise the call option. So basically, as I said, let's say if the bond has a maturity of 3 years, so first 1 years, company cannot call the bonds back. After 1 year only they can exercise. So that period will call it as a call protection period. Is done to provide assurance to the bondholder so that they know they will earn interest until the expiration of the call protection period. Now, if you talk about L to maturity, it's income if you convert into percentage, so that becomes your L to maturity. All right. But in terms of callable bonds and puttable bonds, calculate the will calculate the yield L to call date. So it means, let's say after 1 year, if company call the bonds, then you can calculate the income or yield to that call date only. See, all these calculations you will have to perform if you join any fixed income process, or if you join any, let's say, any process where your key responsibility is to deal with fixed income securities, then you should know it. What is call date, call price, call protection period, call yield to call, because you will have to work on all these inputs. If you don't know how to do, then you cannot perform any activities. All right. So in terms of callable bonds, we compute interest payment for a year as well as for the date of call as well. So it means that if you calculate the income to till call date, so that becomes your yield to call date. All right. Then again, reason for calling bonds. Those who have issued bonds may call them for any reason, many reasons, such as refinancing debt, taking advantage of a drop in interest rates, or eliminating some restrictions associated with the bonds. All right. So these are the, as I said, reason it can be anything. It means depends on your strategies. Risk for a bond holder. So these types of bonds are risky for a bond holders. If there is a fall in the interest rate after the issuing of the bonds, the person who issued it is likely to call the bonds and have it refinanced at a rate that is lower. And in such a scenario, bond holders are likely to get back their principal earlier than they expected, and may have to choose to reinvest them at a lower rates, which will reduce their return. So you would see risk from an investing perspective also. And benefit for a issuer is, this bond provides flexibility to those who issue them, and if the issuer's financial standing improves or the interest rates rise, they can choose to call the bonds. They can and issue new debts at an interest rate that is lower, and thereby reducing their interest expenses. So basically, both can be in benefits. But of course, callable, which is risky for investors, but puttable, which is again risky for company or issuers who have issued the bonds in the market. All right. So types of callable bonds. You can set up governments, municipal and corporate bonds. So you can see with there's different features. And here the important is the last 3 points: full call, partial call. So this one is important one. Set up callable bonds. So you can set up a bonds with like full call, final call. So it depends on the strategy again. So sometime company can call it in a partial amount, not full. Depends on the funding arrangement, right? Or sometime company can call the full amount as well. So it depends. Extendable callable bonds. So this is something, these bonds give their issuer the ability to extend the maturity date of the bonds if they choose not to call it. By exercising this issuer can delay repayment if they choose not to refinance on the call date. So it means they can extend the call date, predefined X date, they can extend to the maybe maturity or any other date in future. So these are the types that you should know, because it matters a lot. You will have to compute interest payment on the basis of this and adjust the interest payments in the books of investor, because I'm sure you're going to join any investment banks, private equity funds or hedge funds. In that case, you will have to work on all of these fixed income securities. So let's take some example to see how it works. Let's say company XYZ issue a callable bond with the following details: face value 1000, coupon rate 4%, maturity date 10 years from the date of issuance, and call date which is 5 years from the date of issuance. Call price 105. So it means call will provide extra 50 rupees benefits to the investor, right? So the first case, if we talk about, the bond is not called after the 5 years call date, bondholders will carry on receiving INR 40. So it means if let's say company doesn't call, then every year investor will receive interest payment. So it becomes the normal bond, right? And bondholder will receive their, which is 1000 at the end of the maturity along with the interest payment. That's all. In second case, if bond is called after the 5-year call date, then bondholder will get the call price of INR 105 for each bond, and they'll no longer be entitled to interest payments, and their bonds will have been redeemed. So this is how your basically callable bonds works. Now if we talk about puttable, so as I said, same example you can replicate it from an investor perspective. So investor will sell it out. So same process if I talk about from a puttable perspective. So it means here the entire process, just replace the word of call, so that becomes your puttable, and update the word which is puttable, and same example you can narrate. So investor sold it out. Only the perspective will change, because investor is very bullish and investor found, let's say, better opportunity in market, better than this, then investor can sell it out bonds. Remaining features and everything, it would be remain same, but in terms of premium, might be that company will buy bonds back at a discount, not on premium. That also happened. The reason is now company will have to arrange the another investor for the same bonds, and this process comes with cost. That could be possibility also. All right. Then the one more important is here, bond price calculation. Very interesting one. Most of the people, they don't know how we calculate the bond price. See, this one is face value. Face value, it means it's a redemption value. But sometime you would see this price on a screen. Percentage 91.75, 102.5, 87.5. So how we can compute bond price? Because actual price that you can see which is this one in the market, but on the basis of what, means how we have calculated it. So here you have a formula, so quickly you can put this formula, percentage in value. So it means this 91.75, if you just see 91.75 into 100 divided by this price. You will get the bond price, and this price, which actually you can see it on a market screen. Market screen, it means Bloomberg, your broker screens, or different platforms as well. So if you see price like this, so you should always compute price in this way to get the exact price of a bonds, because bonds price list or highlight in the market through these ratios. and that's what it creates lots of confusion, like, wait, what would be the price and rate, why it is shows at 91%, 102%, 87%, right, in that way. But yes, so you can calculate in that way so that you will get the idea. Okay, so it means face value of a bond is $1,000, so bond is trading at 917. So reason could be anything, due to company's performance or obligations, or maybe high debt, or they are not able to pay debt. Reason could be anything, guys. These are the possibilities basically. All right. So this is how we compute interest payments. The price of a bonds. So note it down this formula somewhere, or maybe you can take a snap. So it's my personal PPT, so I won't be able to share everything. So this is something that I refer. I will say you can take a snap of this as well. Callable bonds, puttable bonds. So any question now around this? Come on, I would like to take your questions. We have. Yes, Santosh, agreed. If someone is repaying debt before the maturity, it means there could be two possibilities, as I said. If let's say interest rate has not been dropped in the market, but still company want to repay the debt early, so it means company is in strong financial position. If let's say the interest rate which has been dropped in the market, and company have analyzed that they can reissue the debt in the market and save the cost, and in that case it could be restructuring strategy. So it depends. Convention, it means to calculation of bond price, how we compute bond price, because on a market screen, so bond price denote in a different way. So they denote the price of a bonds in percentage actually, right? 91%, 102%, 82%. So how you can compute a price, because base price should be your par value, but on a market screen you would always see the percentage, and that's the reason it creates a confusion basically. So I have given the formula. If you put your percentage, which is 9, if I, let's say, if I want to calculate the price of this bonds, par value of a bond is $1,000. So if I want to calculate the price of a bonds of, the face value of $1,000, and let's say the percentage, it means on a market screen you are seeing the percentage of 91.75. So basically there is a, this bond is trading at discount, so you will get the discount eventually if you buy this bonds at this price, let's say this one. So you will get the, eventually almost 80, not 80, 83 point something, profit that they will receive at the time of maturity. So but how you can compute it? So this price you can put it here, 9175 divided by 100. You can divide with 100 into par value, which is this. So you will get the exact value of this. Then you can treat, and this should be a market price also. So market price of a bond is 917.5, and par value, it means redemption value, because bond always they issued at par value. So basically you would see discount for you if you invest. It's a decent one, so you will get the benefit of 83 on the investments of 917.5. And even if you don't know how to calculate, don't worry about it, because on the market screen they decode everything, price and all. At least the basic is, if you know it, what is the face value or what is the price which is available in the market, so the difference of that would be your premium or either discount. convention, it means again, Rakhi, it's just a calculation that helps you to compute the bond price. Because we calculate bond price in percentage. Here I'm asking you to convert your percentage into amount. Simple. See, if I ask you to calculate the percentage, let's say in general, don't worry about this convention. If I ask you to compute, let's say actual price is 1000. If I ask you to calculate 10%, let's say applied on 1000, and now if I ask you to calculate the price of 1000, actual price of 1000, how you would calculate this? Because 10% I have asked you to calculate, I have asked you to apply 10% discount on 1000. So now tell me what would be the net amount. So I'm sure your calculation would be 10% divided by 100, so which would be around 100 rupees. So that 100 you can minus it from the same amount. $900, so that becomes your bond price, or that becomes your net price, right? The same calculation we are applying here on a stock market screen. Sometime you would see the bond price they have quoted in percentage. Let's say the bond's actual price is $1000, but they have quoted as a 91.75%. So here the simple calculation is convert this bond face value into, means this percentage into price, actual price, to get to know that what is the actual price of a bond. So that process we'll call it as a convention. Convention is nothing but it helps you to calculate the price of a bond. So basically you can convert percentage into price. Simple. All right, any other question, guys? Come on. How was the session? Quick. Other people? You can text. So are you guys able to relate or not? Are you enjoying learning? Good. Okay. So I'm done with today's session, if because we have 10 minutes. So I would like to hand over the session to you guys. If you have any questions, go ahead and ask. I would like to answer. I'll allow you to speak so that we can discuss in just a minute. I'll give you this opportunity to you, because even if I start any topic, because the 10-minute time is, which is very less.